Okay, welcome to the Personal Finance, Unit number 6, Types of Insurance presentation lecture. Please make sure that you have the notes associated with the presentation lecture so that you can take notes down as we go through the Unit 6 material. Now, insurance is a tactic used in order to manage risk. Risk is the chance of loss from an event that cannot be entirely controlled. Now, risk is managed by emergency savings, which can be part of our savings plan, at least 6 months of expenses set aside to cover costs of unexpected expenses, and insurance, which is a financial product purchased by many people facing a similar risk to protect against the risk of larger losses. Now, before moving on to the next slide, just think for a second. What are examples of unexpected events that may result in a financial loss, thus meaning that emergency savings funds must be pulled or an insurance claim must be filed in order to cover those losses? Now, when it comes to insurance policies, a policy is a contract between the insurance company and the insured that states the exact terms of what that policy is. In that policy, coverage is going to be covered, the risks covered, and the amount of money paid for losses under that particular policy. The name of the person owning or requesting the policy is the policy holder, and the premium is the amount paid to keep that insurance policy active, so that in the event that there was some type of a loss, the insurance policy can cover the losses that were sustained. Experts say that buying insurance is buying financial security. Do you believe this is true? Why or why not? Think about that in terms of what insurance policies are designed to do and how they do protect those who purchase those policies. Okay, so let's take a look at an illustration of how insurance works. Let's suppose that there are 100 people in a health insurance group. So these 100 individuals are our sample size, with a 1% chance that any one of them could get sick and require $10,000 in medical care. But no one knows who will get sick. So if each person pays $100 into that pool of insurance, they will collectively have $10,000 to cover the medical costs of the person who gets sick. So everyone's going to give up to $100, but nobody loses more than $100. 99 people do not collect anything, but they gain peace of mind and important protection against a large loss. So what insurance essentially does is it's going to shift the risk of big loss from the individual to a particular insurance company. Thus, the reason for purchasing insurance policies through insurance companies. Okay, let's take a look at the benefits of insurance. Now, one of the benefits of insurance is that payments received from the insurance policy can far exceed the premiums that are paid, but not always the case. And it does provide financial security and peace of mind in the event that a substantial loss has been sustained. Now, types of insurance could be property and liability, life, health, long-term care, and even disability. So the question here to think about is, why is the best outcome to have insurance but never collect on it? What exactly does that mean? We're paying for services we are never able to use. Why is that beneficial in this instance? Think about that for a second. All right, so the insurance process, once we are insured, this is what happens. An event occurs resulting in loss. Could be a car accident, could be a storm damaging our home. What happens then is the policyholder is going to make a claim to the insurance organization. A claim is a formal request to an insurance company asking for a payment when the policyholder has an accident, illness, or even injury. After the claim has been processed, or after the claim has been submitted, the insurance organization determines if the event is covered by the policy. If it is covered by the policy, the insurance company pays out. If not, the insurance company will not. If so, the policyholder pays a deductible. Now, the deductible is the out-of-pocket money paid by the policyholder before an insurance company will cover the remaining costs. Remaining amount owed is paid by coinsurance, if even applicable. Not all insurance policies are going to have coinsurance. Coinsurance requires the insured individual to pay a fixed percentage of the loss after the deductible has been paid. So nonetheless, normally in almost all insurance claim cases, the insurance policy holder as well as the insurance company are going to, in some way, shape, or form, share the financial obligation of recuperating the loss. Usually, almost always, it's going to be more in the hands of the insurance company than the policy holder. Let's take a look at Luis's accident. Luis has a health insurance policy with a $500 deductible and 20% coinsurance, which means that Luis is going to pay the first $500 of any covered medical care plus 20% of the remaining costs. Now, let's just say Luis is in an accident resulting in a $5,000 medical procedure that is covered by insurance, which would mean Luis is going to have to pay $500, which is her deductible, plus 20% of the remaining $4,500 that needs to be covered, totaling $1,400. The insurance company is going to pay the remaining $3,600. So even with insurance, Luis still needs to have the funds to pay the deductible and the coinsurance. What would Luis's options have been if she did not have insurance? How would she go about covering those expenses in the same scenario? Think about that one for a second. Okay, let's take a look at another scenario and let's do the math. So Carlos was involved in an automobile accident that resulted in $3,788 worth of damage to his car. How much does Carlos pay and how much does the insurance organization pay? Well, Carlos has a property and liability insurance policy with a $500 deductible and 0% coinsurance, which means Carlos is only going to pay $500 towards the damage to his car, and the insurance company then is going to pay the remaining $3,288. In this situation, it's a good deal. Let's take a look at another one. Which insurance would you choose? So Janet wants to make sure that she has the best health insurance policy. She has shopped around and received multiple quotes. What are the pros and cons of each policy? All right, so the premium amount for her current policy is $300, or the $200 for the new policy. The deductible amount is $200 for her other policy and $2,000 for her new policy. Her current policy has a 20% coinsurance, and the new policy has 0% for the policyholder. 100% is going to be paid by the organization of the insurance company. So which of these two policies would you choose and why? Think about that. All right, so let's take a look at why do insurance policies include deductibles and coinsurance? Well, this is going to reduce the problem of moral hazard. So if we take a look at when the act of insuring an event increases the likelihood it'll occur, deductibles and coinsurance place some of the loss on the policyholder and not strictly on the insurance company. Each individual can negotiate with the insurance broker their deductible and copay if they wish, or if it's even allowable. Higher deductible, lower copay. Lower deductible, higher copay. Now, an example of that is not locking a car or parking it in a theft-prone area in hopes that it will be stolen and automobile insurance will pay for a new vehicle. Dollars paid from an insurance policy are not intended to make a person better off than before the loss happened. It is only designed to recuperate that loss, not gain profit from it. Okay, so moving on. Sources of insurance. In most cases, individuals acquire insurance from a combination of sources. Individual, which can be purchased, such as long-term care, property and liability insurance. Employer-provided insurance, which might be health, disability, and occasionally life insurance. And there's also government-provided insurance, which are special programs for those qualifying during certain catastrophes. Now, if an employer does not provide insurance, it may be acquired individually. So chances are, if you do not have health, disability, and or life insurance provided by your employer, you would be able to purchase those individually. Employer provided insurance, employee benefits. These are products or services that add extra value to the employee beyond earned wages. Insurance premiums are paid now and divided between the two different parties, the employer and the employee. And the employer in-kind income, this is the donation of the product or service in place of cash. And the employee will receive a payroll deduction to cover that premium. Policies may be available to the employee's family members, usually for additional fees, individual versus family plans. No income taxes are paid on the in-kind income. So if you do have a family, you can also have them covered under your employer's insurance policy for increased premiums, but not necessarily going to have any impact on taxes. All right, so government programs provide basic insurance as part of a social safety net to protect citizens from economic hardship. These are programs such as Social Security, Medicare, and Medicaid. Programs are also going to require a work history, so unemployment insurance, workman's compensation to protect the employee, and then also against unintended Mother Nature catastrophes such as hurricanes, tornadoes, fires, things of that nature. All right, health insurance. So health insurance provides money to pay for health care. It's provided by the employer. Individuals can also pay for it. In some cases, governments can also provide policies. The risks that are covered could be doctor's visits, hospital bills, medical procedures, vision, even mental health treatments, sometimes even preventative care such as physicals, prescription drugs, and even dental care. Every policy is going to be slightly different, but the majority of those policies are going to cover those services that may be needed. Let's take a look at the difference between disability and long-term care insurance. What if a person cannot work or live independently? Disability insurance and long-term care insurance are going to cover these individuals. This is payment to replace earnings during times when workers cannot work due to illness or injury, usually provided by employers and or government, and sometimes even the individuals can cover them themselves. Long-term care insurance, payment for extended nursing care when a person cannot live independently but doesn't need to be hospitalized. So they need to live in some type of an assisted living environment, provided by individuals. Very rarely will you see this provided by the employer, but some instances it is. So why are both disability and long-term care insurances so important to an individual? What are the advantages and disadvantages of both? Think about that for a second. Property and liability insurance, normally covered if you take a look at our auto insurance. Property insurance is payment to the insured person for property damage. Liability insurance is payment to others if a member of the insured household accidentally causes harm to other people or property. Pays for the loss of insured person and pays for the injury or loss to others. The difference between those two different types of insurance, property and liability, usually provided by individuals, almost always provided by individuals. Automobile insurance, payment of liability of property insurance of the vehicle. Homeowner is the same thing in terms of now protecting the home. Renter's insurance is also the same thing, protecting our assets that are in a rented property. If a person drives an automobile liability insurance is required by law. Must prove that you have that type of insurance. Life insurance. Life insurance is covered in case of loss of life. Beneficiaries are the individuals who would receive the money if the insured person does pass away. The dependent is someone who relies on someone else for income and care. All of you are probably dependent on your parents to provide you with income and care. When would it be necessary to purchase life insurance? Think about that one for a second. Life insurance can be provided by individuals or employers and may cover unpaid work formerly done by an individual, and it also can help protect the household for unpaid and child care. All right, so life insurance, it's an infinite, covers for the entire period. Whole life is what you own. Term life insurance is for a period, then it expires and you don't have it. There are advantages and disadvantages to both. So if you're looking to purchase insurance, life insurance, make sure that you look into both. There's a resource for you below if you'd like to click on it. And then what to remember here to conclude everything is insurance is an important part of life. It'll help protect us against financial loss, personal and property. This concludes the presentation lecture. I'll see you